Hello and welcome to BloombergQuint. Indian markets may have got a breather yesterday, not so for its Asian peers. And the handover doesn't look all too happy right now. While Donald Trump's assurances did provide some fillip on Tuesday, the pending announcement has taken the fizz out of the gains. All this at the time when more and more countries are turning to taking precautions to combat the coronavirus. Joining us right now to make sense of the sell-off and the pain is James Glassman. He's the managing director and head economist of Commercial Bank at JPMorgan Chase. Mr. Glassman, thanks very much for taking out the time.
Yeah.
It is an unfamiliar situation that we are being faced with currently. A twin pain of sorts, coronavirus on one side and the overall shock from crude, the economic downturn. You know, investors, even if they have to take a call on whether or not this could come off from the cusp of a bear market and therefore they should start buying, versus some of the others who believe that there's far more pain left on the downside, therefore not being able to decide whether to start investing or not. What's your take?
Yeah, nobody really knows. I think we won't know until we understand better when we have our hands around the spread of the coronavirus. You know, in the Chinese situation, we saw the problem deteriorating, but we knew by early February that was beginning to crest. So you could sort of anticipate that eventually this was going to be coming off. We don't know that yet. It's still too early in the game. And you know what I think what is different this time around is that because any threat to the economy, it's out of the blue, and so policymakers are going to be much quicker to respond because there's no reason why we shouldn't respond. But I will say for India and much of Asia, I really think the interesting development out of all this is the threat to the stability of the OPEC members and Russia. So the decline in oil prices is as a sidebar, is a very big positive for countries like India, China, a lot of the Asian region, including the U.S., by the way, countries that consume more oil than they produce. You're getting, it's a bit of a relief. Yeah. So there is a silver lining in some of this, and we don't think oil prices are going to snap back very quickly. This is probably going to be an issue for a while.
Sure.
Unless the Russians line up with the Saudis and decide to cut output.
Right. In fact, with the crude oil being at around closer to $30-35 per barrel, it's almost a 1.4% boost to the Indian GDP. But aside from that, the markets for themselves are a bit edgy with regards to earnings performances now, maybe decoupling a bit from what the economy does because the rest of the globe is looking so weak. So at this point, a clear tug-of-war between investors, whether or not it's the right time to go ahead and invest or not. And even in the U.S. markets, the initial excitement was there that, Mr. Donald Trump gave some very bold statements saying that there's going to be a big economic boost, stimulus package that's going to be coming in with regards to payroll, tax cuts. But that's now suddenly lost its fizz again.
Yeah, it's very difficult to get a very big package through a political process, as you know. So I think, and if this virus goes the way of most flu viruses, settles down in a couple months, by the time they get these packages put together, it just, it comes way after the fact. And you sort of hope that as the virus season passes, we may see a fair amount of revival without the help of stimulus, as we're seeing in China, for example. But of course, the government there took a lot of actions also. So I think what's really interesting, though, when you think about it, what's going on now is very similar to what happened last year. You come into the year, people are worried about trade tariffs. Interest rates drop sharply, the Fed cuts rates, and yet the equity market continued to rise. So if you had been asleep for a decade and you woke up today and you looked at the valuation of the U.S. stock market, you would not conclude that the market is panicky about anything big. You would not conclude that the market is pricing in recession because the valuation of the U.S. stock market is very generous, roughly 14 times earnings. And so it might be that the equity market, nervous, of course, but we're down 14% from the peak. But it might be that equity investors are figuring that one way or the other, the virus passes and we get some stimulus out of it. And maybe they're trying to take the long view. It's hard to know. It's just way too early to know what to think about this right now because we haven't really seen. We're in the very early stage of the virus spreading in the U.S. and we don't really know where we are in that process.
Right, closer to 800 reported and about 28 mortalities. Just to, another question being is, while up until now everyone thought of, hiding in safer haven investments like the U.S. Treasury, now with that cratering, the U.S. Treasury yields coming off sharply below 1%, do you feel that that's actually a silver lining for people to start looking at higher dividend yielding stocks now, and investors could flood that way? Because as of Friday, post the collapse, it seems as if 3/4 of the S&P 500 companies are at a higher dividend yield than the U.S. Treasury itself.
Yeah, I think investors should think like that if you've got a relatively constructive view of the long term. But other people may say, no, but these dividend yields won't hold up if companies have to make adjustments and cut dividends. So you're kind of at an odd position. You don't quite know what to make. But, I mean, if your alternative is equities or sovereign debt yields that are giving you negative if you're in Europe and Japan or the U.S., these are not very attractive returns. And it's hard to know why. I have a feeling that all the asset purchases of central banks have really made it very difficult to interpret what the sovereign bond yields are doing, because these yields don't make sense.
Right, got that. James, thanks very much for joining us with this quick perspective this morning. So, James Glassman there of JPMorgan talking about what's been happening in the globe across asset classes. Still a lot more pain that's there in the system at this point. Markets are still pretty generous with valuations, even post this correction. Thanks a lot for staying tuned.